Why should retailers care about embedded financial services? Globally, e-commerce is growing at a phenomenal clip, 30% CAGR by some estimates. Yet, selling in some ways is harder than it's ever been. Competition is huge, customer acquisition is getting more expensive, supply chains are still broken. So things like boosting cart sizes, LTVs, reducing cost, and finding new revenue streams is critical. This is where embedded financial services gives retailers a new arsenal of tools to deploy. Today, we're going to unpack these tools. The first one is insurance. I don't mean upselling home insurance when you buy a sofa. That's been around for years. I mean micro-insurance, directly relevant to the product you're selling and the journey it takes to get to the customer through things like extended warranties or shipping protection. The more confidence buyers have in the product, the more likely they are to buy. It's just common sense. Embedded insurance does this by utilizing parametric insurance, where an event detected by a trusted source, maybe like a logistics provider or an IoT sensor, triggers an automatic payout. Think of examples like flight delays or lost goods in transit. Payouts for these can now be automated, and we're seeing new embedded insurance players like Cover Genius tie up with underwriters to bring these new insurance products to market. Cost is critical here. The insurance needs to be a small percentage of the product value to be compelling. Imagine you're buying an item worth $50. There's really a limit to how much money you're willing to pay for insurance. Parametric insurance, by cutting the cost and time of processing a claim, is critical to making embedded insurance an effective tool for retailers. A final boon. The acquisition cost for an embedded insurance policy, such as within a retailer, is significantly cheaper than traditional forms of distribution for the insurer, making a revenue sharing agreement a no-brainer between insurers and retailers. 2. Utilize financial services products to build a deeper relationship and get more actionable insight into your customers. This will help you to enhance loyalty programs, generate cheaper payments, and find new revenue streams. And I don't necessarily mean buy now, pay later. Don't forget that BNPL makes their money by amping up merchant fees and keeping crucial customer data to themselves. After all, they have to make money somehow, right? First, start by fixing the payments pipe. Payments are a mess. The larger the retailer, the more fingers in the pie, charging you money and leaving you further away from the customer's data. Think different payment types, geographies, banks, and other intermediaries involved. In fact, according to research by Checkout.com, roughly 40% of surveyed merchants received absolutely no actionable analytics from their payments data whatsoever. Even TikTok was struggling. JP Morgan have just finished overhauling their payments infrastructure. Users can now get paid out instantly in multiple currencies, and TikTok themselves can now see transactional data end-to-end. 2. Bring open banking into the fold. We're still left with the fact that credit and debit card feeds erode margins. 1 to 4% in fact, and here's where open banking can really come in. Bank-to-bank payments are up to 90% cheaper for the retailer than debit and credit card purchases, as card networks and payment aggregators are removed from the pie, leaving the retailer the ability to see the data. Bank-to-bank payments are no longer on the sidelines. If you're in India, for example, it's now the default payment method. UPI handled 38 billion transactions in 2021 alone, and in the UK, open banking payments have grown roughly 200% last year. The West has definitely been far slower to adopt open banking than countries like India, but people are getting more comfortable with its use. The next one is to launch a digital wallet, because we can then use open banking as a foundation to build a deeper financial relationship with our customers. One way to do this is through a digital wallet. According to FIS, digital wallets are on track to have a 52% share of e-commerce payments by next year. That's 2024. And the smartest retailers are using them to build loyalty programs on steroids. How? Well, once money gets loaded into a wallet via an open banking payment, transaction fees more or less cease to exist. The retailer can then pass some of these savings on to the customer and use behavioral data to reward them. Digital wallets are key to Starbucks' strategy, for example. Their loyalty program and wallet is hardwired into the payment experience and makes up 50% of their business. To be honest, that's higher than I would have expected. Now, finally, we can launch our own financial products. We now have a detailed real-time understanding of our customers' behavior. We're keeping them in our ecosystem, and now we can amp things up. How about things like offering deposits and savings accounts, attaching a virtual debit card maybe to your customer's wallet and claim some of those interchange fees? With a financial relationship established between a customer and a brand, risk profiling becomes clearer. And you're in a far better position to share risk with underwriters and banking-as-a-service providers. In fact, as we talk in 2023, those providers themselves are maturing. More of them have banking licenses, richer features for data sharing, and there's also more choice out there. In 2020, the whole BaaS sector was worth just $2.4 billion, a tiny subset of the wider software as a services industry. But it's growing fast, and now might be the time to find the right partner. At 11FS, we design embedded finance strategies and new customer propositions for clients all over the world, including retailers. Give us a shout. We'd love to help.